So, fine. As far as corporate guarantee is concerned, this has been a topic which has been a subject matter of litigation, not only in GST law, but also in the old service tax law. By the way, just a small check. I won't do this check again. I hope I'm clear to all of you in the sense the voice is very clear, the screen is clear. Perfect. So this concept of guarantee, the taxation part of it, has been a subject matter of litigation, not only in GST law, but also from the erstwhile service tax law also. There's not been a free from litigation. In fact, what I'll do is, I'll take you through the entire timeline as to this particular, how this corporate guarantee taxation has evolved right from 2017 onwards. In fact, before that, before GST or 2017, I'm telling you about the GST timeline. But what I'm trying to say is, even before GST, the litigation has started, even in service tax era, etc., etc. And if I am right, not less than 10 years worth of litigation, we are able to see at a minimum in this particular corporate guarantee issue. Now, if you see the timeline, the entire story started to blow up. Earlier, it was at a nascent stage, but the entire story started to blow up with the judgment of the Honorable Supreme Court in the matter of Edelweiss. As we can see, in the year 2022, the Edelweiss judgment of the Supreme Court came, wherein a landmark judgment in service tax era, which said that if there is no consideration received for giving the guarantee, then in that case, there is no service tax at all. This was a judgment which came in 2022, but it pertained to service tax era. There is no consideration you are receiving. Then in that case, no consideration, no GST. If you receive money, only GST, right? So that was a logic. Now, after that, but if you see the concept of this consideration, it has changed in GST law, wherein we know concept of section 71C read with schedule 1, where even transactions without consideration also are liable to GST. So that is where the matter Edelweiss cannot be completely relied upon in the GST era. We'll talk about all that. So therefore, Edelweiss. Then whether this corporate guarantee was taxable or not in GST era was again litigated. The matter came to the forefront in the year 2023, which is 2 years back, almost 1.5 to 2 years back, in October 2023, wherein this particular valuation rule 28 sub-rule 2 was introduced, specifically covering corporate guarantee. So this was the next landmark amendment. Now, does it mean that before this, there is corporate guarantee was not taxable? You can't take that view. Please note, this 28.2, as all of you know, rule 28 is a valuation rule. So the valuation method was prescribed. Doesn't mean that before that it was not taxable. Does that now the valuation method is now made very clear? Earlier it was governed by 28.1, the general rule of valuation of related party transactions. So 28.2 was inserted, and once it was inserted, a huge hue and cry. We all made a huge hue and cry. So many drafting errors, just like how in the Safari judgment, the government simply admitted, not just a drafting error which is there. Like that, there were many drafting errors. 3 sentences only. I used to say, boss, you're writing 3 sentences. And the 3 sentences like evlo mistake. Then how do you expect taxpayers not to make any mistake? So anyway, 3 small lines was there in 28.2. So many drafting errors. Amended couple of 3 times it was amended. 3 lines. We can use Tamil in between. 3 lines amended 3 times for a period of 3 months. So all these amendments happened. Then in that, after that one, the case of GST itself, Sterlite power transmission case before the Delhi High Court, where this entire levy of GST on corporate guarantee without consideration was challenged. The case of Sterlite power. Then again later in 2023 October, after the amendment came, circulars were issued. 2 circulars broadly, one circular 204, other circular 225 as it's written here. Both the circulars were introduced, clarifying various aspects as to the evaluation mechanism and general taxability of corporate guarantee. So 2 circulars were introduced, 204, 225. These circulars also had a lot of issues. So many issues. We'll see all that today. So because of that, again, it led to another round of litigation, wherein one prominent case is that of Acme Cleantech. The circular 204, which I was just referring to right now, was challenged, and in fact, the entire adjudication or whatever proceedings were initiated, the stay was issued in this particular case. Stay of proceedings was issued. in the case of Acme's Clean Tech Solutions. So we'll see all these cases as when we come to. Therefore, what I'm trying to say is, you can see the hot entire timeline wherein this entire matter was litigated. It's not free from that one. Hence, we are having this particular session. Now, I have to, my thumb rule is I don't talk for more than 10 minutes at a time. I ask questions, right? So whether you're physically there or not, also probably we'll see. I won't ask very complex questions. That I'll take care. So probably a little bit of a basic level question, so that let me see your interaction also. Now, first question for all of you. You can just put it in chat, or you can unmute and say whichever is comfortable, possible, you can do that. Now, please tell me, as far as guarantee is concerned, it is a contract between how many people? Any idea, anybody? In a guarantee contract, typically how many people are there in that particular, are parties to that particular contract? 5, 6, 7, 8, 3. So unanimously, I'm getting the answers as 3. Okay. Now, anybody has a different answer? Shriramji is saying, I think, welcome Shriramji from, I think, LG. So, yeah, I think he has started by saying the correct answer, which is, I also, and this is the correct answer also. There are only 2 parties. So, so thank you, Shriramji, for answering. So, if you see anybody, and from people from Veritas are also answering, right? So it's only 2 parties. I'm not sure how many of you have seen the contract of guarantee, actual contract of guarantee. I'm not sure how many of you have seen. There are signatories to any contract, correct? If you see contract, the guaranteed person never signs it. It is for his benefit, okay. Or the debtor never signs it. Guarantor and the what is that? The creditor. Only these 2 parties will sign that guarantee contract. Therefore, 2 parties are involved. Okay. Anyway, basic question I have asked you. So some interaction has started. I think you can mute yourself also. Request you to move that. Now, having given this introduction, let us start off. I don't want to take it theoretically today. There are some 25, 30 slides which are there. Even if I give the slides to you, you can go through. That's not the idea today. We'll take it very practical. I'll just give a simple case, a live case, which we had also had the opportunity of defending to a large extent, successfully defended, got favorable ruling also. So I'll give you a live case without probably telling the name of the person. So a live case where we have successfully defended this matter before the appellate authorities. So I'll just give that situation, and I will ask you have to bear with me. 5 minutes is a long story, which I have to tell many facts of the case. Then probably I'll get your feedback as to how exactly the points to defend the matter are there. Many taxpayers are here, so how exactly we defend this matter? We'll take it like that. Facts of the case. Now, bear with me for 5 minutes. I'll give you the entire story, entire facts of the case. Now, take a situation where in a guarantee contract, there are only 2 parties, correct? But it involves 3 people. So let us take, that's why you got, many of you gave the answer 3. 3 people are involved, but signatories are only 2. The privity to contracts only between 2 parties. Now, let's say a party, let's say company X is there, X1 is there, let's say it's a holding company, let me write it as XH, okay, it's already written here, fine, XYZH, XYZS, which is the subsidiary company, and the creditor is ABC. So, ABC is the creditor, let's assume. Okay, it may be a bank, let's say ABC is the bank, okay, so it's the bank which is giving the money, loan, something like that. You imagine a loan. Imagine a loan of, let's say, some 70 crores, let's say 100 crore loan, big loan. You can imagine for a huge project, huge plant to be set up, whatever it is, a huge loan is being given. Therefore, please note a loan is being advanced for, let's say, some 100 crores or something to the subsidiary company by the bank. Now, the bank will not give this loan as such. It will ask for a lot of, what is that, we can say, a backup or a security sort of a thing. One among the security given is the guarantee. So corporate guarantee between companies. So guarantee is given. So excess, the company excess is not known to anybody, but I know your holding company. It is a huge company. It has a huge background. So you give me a guarantee. So the holding company will give a corporate guarantee to the bank. Right? Now, please note the point to be noted is it is given at the insistence of the bank and not at the insistence of the subsidiary company. This is a point to be noted. So at the instance on the bank, guarantee is being given, a guarantee contract is entered into. Typically, there will not be any consideration at all. No consideration whatsoever. There will not be a single money being given by subsidiary company to holding company. Of course, they are group companies. So typically, it is all consideration. There are also certain reasons why there should not be any consideration in the guarantee contract as per RBI regulations. We'll come to that one by one. Because the RBI regulation, if you see the master circular on guarantees, etc., in the case of personal guarantees, RBI prohibits directors taking any commission for giving this guarantee. Prohibits. It should not be used as an office of profit, correct? You're already getting a salary as a director or a remuneration as a director. You should not get something over and above. Office of profit. Same concept is there for a holding company, this one also. So holding company should not use as an, again, manner of enrichment, being a related party. So therefore, there's, because of RBI guidelines, though it's directly applicable only to personal guarantees, the concept is similar and can be extended to corporate guarantees also. There are only two types of guarantees, broadly speaking. One is personal guarantee given by persons or directors. Second is corporate guarantee given to companies. So what applicable to personal guarantee can be extended to corporate guarantee. Fine. So therefore, there's no consideration received. So these are the basic facts of the case. Now, what happens in this particular case, I'll tell you, probably the contract was entered in the year 2018, you can assume. The guarantee contract, the loan was sanctioned, and the guarantee agreement or contract was entered into in 2018. Let's call this as year zero. Year zero. Now, what happened is, see, this is where this concept of guarantee has a lot of complexities. I already told you Contract Act, right? Contract Act says it's a two-party contract only, not a three-party contract. So Contract Act provisions are involved. There are RBI guidelines in this scenario. Now look at it. There is also the concept of Ind AS, accounting standards. Accounting standard concepts is also involved. Now, Ind AS 109, for those who know, Ind AS 109 is also involved in this picture. Now, what does Ind AS 109 say? It broadly says two things. One, initial measurement, and second, subsequent remeasurement. So initial measurement means year zero. Subsequent remeasurements means, let's say this loan is for some 10 years. So from year 1 to year 10, what should be the remeasurement? So subsequent measurement from year 1 to year 10. So it gives the accounting treatment in whose hands? Predominantly in the hands of the holding company. Now, what does it say? It says in the initial year, year zero, see, you are giving a guarantee for some, let's say 100 crores. There is a possibility of default by the subsidiary company, correct? You measure that possibility, whether it is a 2% risk of default or 10% risk of default. What is the risk of default by the subsidiary? You measure that one, initial measurement. So once you measure it, fair value of that, present value of that is to be recognized as a provision and a corresponding liability in the books of the holding company. An expense to be recognized, just like any provision you put for any expense. Like that, an expense, provision, and a corresponding liability should be recognized in the holding company's books. Let's say in this particular case, a 5 crore liability for a 100 crore loan, let's assume just for easy calculation purpose. Okay, take 10 crores. 10 crore expense and a liability is recognized in year zero in the books, that is 2018. In the books of the holding company, an expense and a liability of 10 crore is being recognized. Then year 1 to year 10, what happens? The accounting standard says remeasure it, because 1 year has now elapsed. The risk will come down, correct? You initially you recognize an expense and a liability, provision for expense and a liability of 10 crore. Every year you remeasure it. The liability comes down, correct? The risk of default comes down. See, more and more time elapses, it means you have repaid some amount, etc. Therefore, the risk comes down. So it says remeasure it. Every year, write back something. For easy calculation purpose, let's keep. In this scenario, it is not like this, but for easy calculation purpose, let's assume from 2019 onwards, every year, 1 crore is being written back. Please note, written back will be an income. Just like how initially expense we are measuring, if you write that back, it will be an income, correct? So every year, 1 crore write back is happening. So at the end of the 10th year, expense, income, liability, asset, everything will be same, squared off. That's the entire concept. So for 10 years, each year, 1 crore write back is happening. Now, what's what happened? The authorities picked up this particular amount of 1 crore, which are recognized from year 1 onwards. Picked up this amount. It will be shown in the face of the P&L account itself as guarantee income. Authorities picked up this amount fine, you're receiving a guarantee income, it's a consideration you're receiving for giving the guarantee, therefore issuing a show cause notice to you. On this 1 crore, 18% GST, please pay it, 18 lakhs per year plus interest plus penalty, section 74, so on and so forth. So these are the facts of the case. 5 minutes I've taken. Now, having seen these facts of the case, now let me ask a few questions. Learned members are here, big captains of industry are here. So therefore, let me ask a question to you. If you are getting this notice, what are the grounds of defense that you will take? You see, we are the experts here. We are here to guide you. I'll probably take you through what the grounds are. But probably all of you sometimes may have more knowledge of the industry than probably us. So therefore, I'm asking you. So you give your views without any inhibition or anything, right? Mostly, sometimes your view may be even much more nuanced view. So please tell me, what are the grounds you get this notice? How are you going to defend it now? What are the views that you're going to defend? Anybody? Let me see the chat. So you've got this big notice. Let's say some 2 crores plus interest plus penalty. You've got the notice. 5 years audit. Pick this up. Fine. So I'm getting many answers. Good. So there's no actual income. There's no actual consideration received. It's not consideration from anyone. It's notional value. So I think one of our clients was also having this guarantee issue is also here. So good, sir. Fine. So the notional value, no consideration, but it's not your case, sir. It happens to be somebody else's also. Anyway, yeah, so no notion, this is only notional income, not an actual income. That's what you're trying to say. Correct. Perfect. As simple as that. There are settled Supreme Court judgments, even in erstwhile era and in the current era. First point itself is a good point for defense. Erstwhile era service tax also, excise also, more specifically GST law, Ralco Industries last year, 2024, what is that, ELT, 2024 ELT citation, you can see Ralco Industries, latest case law I'm saying, which says the balance sheet figure or the P&L, whatever income is there, you cannot pick them straight away and levy GST on it. You have to see income is not equal to supply. GST is a tax on supply, correct? It's not a tax on income. It's not income tax. GST is a tax on supply. Whether that income tantamount to supply is what we'll have to see. Therefore, without establishing that, you can't pick up the figures directly from the P&L account and go ahead with it. Not possible. So that's the first defense. So that 1 crore, what I'm saying here as per accounting standard, that's not supply at all. That's not consideration for supply. This is not consideration for supply. Then is there any other consideration for supply? That's the question. Now, please understand one more thing you have to notice. XH and XS are related parties. I hope you have noticed that one. I told holding and subsidiary. Therefore, if you look at explanation, I'm writing all the provisions in this side, right? So if you look at section 15 of CGST Act explanation, it defines what is related party. Holding subsidiary will come under related party, right? Control is there. So they are related party. So if it is a transaction between related party, then in that particular case, it falls under section 7(1)(c) read with schedule 1, wherein even without consideration, it is liable to GST. This 1 crore is not consideration, fine. There's no consideration. Even then, it is liable to GST. All of us know schedule 1 transaction, even with there's no consideration, it's liable to GST. Therefore, the authorities precisely picked up this point and says, okay, XS and XH are related parties. I understand this 1 crore could be consideration, but even if it is not consideration, 7(1)(c) schedule 1 will come. Therefore, it is tantamount to taxable or a deemed supply liable to GST. Is this allegation of 7(1)(c) correct or not? I accept. You have given your views that there's no consideration. But being a transaction between related parties, is it covered under schedule 1 is the next question. Anybody has answers for that? So since probably you don't have a lot of time, I'm quickly moving on. If you look at it, so this is where it comes. The show cause notice said either under 7(1)(c) it is a deemed supply, or under 7(1)(a) this 1 crore is a consideration. Therefore, it is a normal supply. In any case, it is taxable. Now, if you ask me, this is also wrong. Show cause notice cannot pick and choose. If I can say so in Tamil, I can just use somewhere in between. Your honor, நீங்களே போட்டுக்கோங்க ஒரு செக்ஷன் அப்படின்னு சொல்லக்கூடாது. You could not say like that. Show cause notice cannot be vague. It has to be very precise. Again, settle the decisions in the case of Nestle India, Senfa drugs, n number of cases. It can't be vague. It has to be precise. You have to say this particular section is the thing that you're getting covered under. So that was also a defect in this particular case. You can't say either 718 or 711C. Somewhere you take, you are liable. You can't say like that. You have to say 718 or 711C. What is that? So therefore, now I ask you the question, will it come under 711C, transaction between related party without consideration? Answer is, if you ask me, let's take that one by one and see. If you ask me, if I can erase all of that in the screen, fine, let it be there, not an issue. If you ask me, it won't come under 711C, transaction between related party, it won't come under. Please understand, you all told me that guarantee is a contract between two parties. Many of you beautifully answered. Now, contract is this guarantee is a contract between two parties, correct? But which two parties? Is it the holding company and the subsidiary company? Answer is no. Who are the signatories to that guarantee contract? It is the holding company and the bank. They are unrelated parties, are not related parties. Therefore, this basic understanding is not there. If you ask me, even Rule 28, what the rule has come, I will tell it is ultra vires in many aspects. It is unconstitutional. It will be challenged. We'll be, even in our firm, we'll be having so many cases we'll be representing. I'm pretty sure about it. Circular 225, 205, Rule 28.2 itself has a lot of grounds where it can be challenged. Unconstitutional, ultra vires. It is not a transaction between related party at all. Why? Because if you look at the guarantee contract, it is between H and that is the holding company and the bank, who is a creditor. X, it is for the benefit of the subsidiary company. No doubt about, nobody questions that one. Everybody understands it's for the benefit of the subsidiary company, but it is not the recipient of supply. The recipient of supply is the bank who insisted for the guarantee in the first place. It is also a beneficiary. So if you look at the law, it is the recipient of supply. Supplier is the guarantor. Who is the recipient of supply? It is the ABC bank in this particular case. Therefore, it is not a transact. Bank and the H company are not related. So it doesn't come under 7.1C. So that's the first thing that probably we can observe. The second thing that we can observe is that, okay, sir, fine. It is a transaction between unrelated party. Let me take ABC Bank and X, they are unrelated party only. But this 1 crore is a consideration. That is a write back, as we already seen. So therefore, it will fall under 7.1A, which is covering normal transaction for a consideration between unrelated party also. If consideration is there, it is liable to GST, all of us know. So it will come under 7.1A. Answer is wrong. That's also not the case, because we have seen that all of you told me very correctly that this 1 crore is not actual income, but it is only notional income as per accounting standard. That cannot be treated as actual consideration. There is no consideration here at all. So 7.1A also will not come. It is not a normal supply. There is no consideration here. So 7.1C will not come. 7.1A also will not come. Fine, sir. Now, for a time being, you ignore these two. So it is not a supply at all, liable under GST law. That is the first thing. Now, to add to this particular aspect, the next thing, let's take, okay, sir, supply itself is not there. Fine, let's leave it. Assume supply is there for a second now. Either section it is coming, 7.1A it is coming, or 7.1C it is coming. For a second, you assume one of the things it is coming. Then in that case, the next thing we have to see. Now, what is the assuming? Let's take for a second, it is coming under 7.1C itself, related party transaction without consideration. Schedule 1 transaction. Therefore, now next step we have to go, okay, supply is there. Actually, it's not there, but assume supply is there, 7.1C. Therefore, next step we have to go. Is there a consideration, or is there an open market? Consideration is not there, fine. 7.1C consideration is not there, but is there a market value for the supply? Because now we have to go to Rule 28. That's what we are going to discuss in detail also after this. Rule 28, what does it say? You take the open market value of the supply. Okay, actual consideration is not there. Okay, fine. But if it is a related party, it is taxable. Therefore, you take open market value. Let me take the open market value now. Now, if we proceed to take the open market value under Rule 28 sub Rule 1, leave aside Rule 28.2, which will come to next, the latest amendment. But if you go by Rule 28 sub Rule 1, the open market value in this particular scenario is also a big zero. Why? That is where the RBI circular comes. As I've already told you, the RBI circular in case of personal guarantee clearly says that you're not supposed to charge any consideration. So in the RBI circular itself say no consideration should be charged, and the open market value is definitely zero. Market value is zero only. Leave that aside. You take the guarantee contract and you see every standard guarantee contract that you'll have. If you have it in your company, you take it and see right away. It will have a standard clause saying, if it is a holding subsidiary company giving the guarantee, it will have a standard clause which says the consideration should be zero. It is not a magic thing or a standard template everybody is copy pasting, sir. No, it is based on the RBI circular. So the contract itself will say, the guarantee contract itself say no consideration should be charged. Then in that case, how come there is a market value? There is no market value. You are prohibited from charging any consideration as per RBI, as per the contract that you have entered. Contract law, consideration is zero. So market value also becomes zero. So assuming there's a supply also, next step valuation fails. The open market value becomes zero. Therefore, this also could be taken as a defense. So then comes the next defense. There are many judgments in the context of transfer pricing, income tax, microing being a very prominent case, DLF being a very prominent case. In the context of income tax transfer pricing, there are case laws which say another important aspect. I've given you many grounds probably. The next important aspect which these cases say in context of income tax, judgments are there which say that leave aside 7(1)(c) or a 7(1)(a), there is no supply at all. There is no transaction at all here in this particular scenario. Why? Because please understand the basic aspect as to why a guarantee is given. Why is a holding company and giving a guarantee to a subsidiary company? It is a shareholder function. It is my company. It is my subsidiary company. It's my group company. As a instead of, see, I can give contribution to my company in two ways. One, I can give money consideration, correct? It needs 100 crore loan, I can give it myself. I don't have that. So I ask him to go to a bank. So I can give a money consideration, money capital I can give. Second is non-fund. Bankers know this. Those who are bankers here will know this. Second is form of non-fund contribution. What is non-fund contribution? Guarantees like this. In fact, as per banking terminology, when they see the we call concept of capital, quasi-capital. This non-fund consideration forms part of quasi-capital. Quasi-capital means it is like capital only. Just that it is non-fund. So this guarantee is a non-fund. Without money being involved, you are giving sort of a capital. So therefore, it is a capital contribution, not a supply. So it is tantamount to money being put. Transaction money. It's not a supply at all. Therefore, this concept is being established in many transfer pricing cases. Therefore, on account of all these things, apart from this, there are many other things also, which we can definitely take as an argument. On account of all these things, probably this case we had again successfully represented, and therefore we got the payroll order also. Anyway, that's another thing. So having seen this, so these are the nuances of the guarantee contract. So in essence, if you ask me, the basic concept of corporate guarantee, whether it is taxable or not itself, is a huge question mark. I have not even gone to, sir, so slightly people tend to ask me this, right? But I hope it is engaging. But the point is, I have not even gone to the valuation rule 28, which is the only provision in the GST law it talks about corporate guarantee. The fourth challenges are there. These challenges have to be assailed. Then only we have to go to valuation. It's an incidental concept. It's a mechanism provision. But basically, supply irka illiya. We have to see that, right? So there itself, all these litigations are there. So that is what I thought I will point out to before we go on to the actual rule itself. So having seen this, now let me move on. So now I'm again putting you the provisions which probably you can go through. Now the section 126A of Indian Contract Act. I'm now taking you through the provisions. So what I'm trying to say is this contract or a corporate guarantee contract, it involves the interplay of multiple laws. You have to see Contract Act, you have to see RBI guidelines, you have to see Ind AS, right? You have to understand the business concept also. So it involves an interplay of a lot of things. Incidentally, GST Act is also there. That's what I'm trying to say. So ideally, the title should be what is a law on corporate guarantee rather than GST law on corporate guarantee. GST law is incidental if you ask me, but we are here because of GST issues only. But anyway, so now you look at Indian Contract Act, as you rightly said, it is basically a contract between the surety and the creditor. The debtor is, it is for his benefit, but it is a contract between two parties established by the section 126A, 126 of the Indian Contract Act. Then RBI guidelines which I was talking about, I've also extracted the relevant para here. So it says that in case of guarantee, the consideration should not be charged for personal guarantee. Now moving on, again, I've talked about all these cases. So I've talked about this Edelweiss, I've talked about this income tax cases. All of this I've discussed in that one particular case itself. That's why I thought I'll tell it as a story. Otherwise, if I just keep on putting this PPT, then it will become very dry. So I think I connected all of that in that particular one particular thing itself. So it's what I discussed only. So I'm quickly moving on. India is 109 I discussed. So therefore, if you come to the contract of guarantee, now coming to this one, we have to answer these questions before assuming it is taxable. You have to answer these questions, whether it is a goods or service. Okay, sir, service, fine. But is it a supply of service under 71C or 71A? Who are the contracting parties? Is the open market value nil? After answering all these questions, now we come to the valuation rule, Rule 28 sub rule. So now I'll come to the hotly debated, because today I can't end the session without showing this. No, we're not nowhere near the end, but this is somewhere in the midpoint. I have to show you this Rule 28 sub rule 2, which is the only provision in the GST law, only provision apart from two circulars, which deals with corporate guarantee. What does it say? It says, please have a look at it. Please note, this is sub rule 2 of Rule 28. What is Rule 28? It is valuation rule, first of all. First, we have to understand that it is not a rule levying tax, it is a valuation mechanism only. So first we have to know whether it is leviable to tax. That's what I was trying to point out all this time. Very question mark. Now we come to valuation. What is the value of that guarantee? 1 crore, 2 crore, what is that? 10 crore, what is that? Valuation. There, with effect from 26th October 2023, sub rule 2 has been newly inserted, which talks about the following. Again, if you ask me, look at how many corrections. What I have shown in the bracket is the correction. Moon corrections have happened after the amendment came. Appu. See, where the law is good, I've spoken in so many forums. I've spoken before ministers, I've spoken before executive people of the administration also. I've shared the dais with them. Before them, I've told openly where the law is to be criticized openly. I don't say, I'm speaking the truth. I don't need to worry about what will happen or not happen. So I've told very openly. So here, where the law is bad, I tell openly. Where the law is good also, I will tell openly. Many areas is good. Beautifully drafted provisions are there. But this is one of the provisions where it has been bungled up like anything. Even after these amendments, it has been bungled up. Already 3 corrections are there. But if you ask me, the entire rule is to be scrapped and it has to be given. Anyway, that apart, let me read through the provision. Notwithstanding, so non-obstante clause is there. Notwithstanding anything in the general rule, sub rule 1, the value of the supply of services. One second. The value of supply of services by a supplier to a recipient who is a related person. So as I was saying, it is a valuation rule between related party transaction only. Located in India, this is a very important point which many of us will fail to notice after amendment this came. Therefore, if you notice very carefully, if the recipient should be a person located in India. Therefore, if you look at it very carefully, it will not apply this section anyway. I'll read to then I'll come to where it will apply, where it will not apply, like that. I'll come to that next. But if you look at it very carefully, the recipient is located outside India. In this case, it will become an export, correct? Or a cross-border transaction. Typically from India to outside India, right? Then in that case, it is not covered by the sub rule 2. So export of corporate guarantees from India, now we are investing outside India in many places. So subsidiary companies are located in US, UK, Singapore, so many places. So from India, we are giving guarantees to outside India. Then in that case, this rule will not apply because the recipient should be located in India by way of corporate guarantee. To any banking company or a financial institution only. Therefore, the creditor should be a banking company or a financial institution only. Please note, if it is a private loan or an out-of-banking system loan, in that case, a corporate guarantee is given, then this rule will not apply at all. So if it is a non-banking party who is the creditor, then in that case also this particular rule will not apply. So since we are short of time, I am quickly telling what is outside the scope of this rule. So if it is a banking company or a financial institution who is the creditor, then in that case, the value shall be deemed to be 1%. Please note very carefully, then amendment came 1% per annum. So the value shall be 1% per annum. Or, so this is A, or the actual consideration or the actual commission, guarantee commission received, whichever is higher. So A or B, whichever is higher. Indian law is always higher only, nothing lower. So therefore, whichever is higher. Provided, but please note very carefully. So the value shall be A or B, whichever is higher, fine. Now, before I go to the proviso, so since I've talked for 10 minutes, my instinct starts. Now, let me ask you another question. So in our example, I told, we saw one case. So typically assuming guarantees are taxable, that itself is a question mark, all that is there. In our case, how much should be the value of the guarantee as per this new sub-rule 2? Assuming this new sub-rule 2 is applicable. Please note, new sub-rule 2 is applicable only from October 2023. Before that, we'll come. So let's assume for a second it's applicable. Then in that case, anybody? So let me see some answers. 1% per annum. Please understand. I told it's a 10 crore loan. 10 crore, pardon. I told it's a 100 crore loan, right? 100 crore loan for 10 years. Yes, perfect. So thanks, Iggy. So I'm happy Iggy has caught on. So actually, Iggy is a non-GST person, so he is catching on. So and he has given the correct answer also. I think clap is due. So which I'm confident that now I'm not speaking any Greek or Latin. I'm reaching out to all of you. So he has given the correct answer. In fact, so 1% per annum. In our case, it is 10 years loan. I told. So therefore, 1% multiplied by 10, 10%. So 100 crores a loan. So 10 crore, perfect answer. So it should be 10 crore. That is the value of the guarantee if this rule is applied. In our case, 10 crore. Now, can anybody tell me, do banks charge for a 100 crore loan? Do they ever charge a 10 crore guarantee commission? Captains of industry are here. Now, please tell me, should this rule have been only 1% or should it have been 1% per annum? Let me ask a question, an interesting business question. So all of your captains of industry here, sitting here, and you tell me the business. I'm telling the law, you tell me the business. Because I told this, I argued this before the authorities. This is like illogical. For a 100 crore loan, guarantee commission will be 10 crore. Is it correct? Over and above interest, all those things. Now you tell me, what is the market rate for any guarantee? Should it be 1% only or 1% per annum? What should have been the law? What should have been the market value adopted? Can anyone tell me? My question clear? What is saying 1% per annum, sir? Ablo commission per annum 1%. Market value adana. Rating, fine, sir. Normal rating, sir. Let's assume, okay, fairly good rating is there. Let's say it's not C minus or something, right? But I'm asking you, see, there's a huge gap between 1% and 10%, right? Even assuming an average rating, which is there, what should have been the value? Exactly. I don't know. I don't think it can be more than 1%. Who will give a 10% guarantee commission for 100 crore? 10 crore guarantee commission for 100 crore. So it's illogical. See, you rather Tamil, if I can use, people all over from India are here, but still I have to ask. But you will ask, so I can't fathom this probably from what basis they have taken. So Shriramji is saying 0.5, which is correct, sir. Good rating should be that not more than 1% in the whole lifetime. Probably depending on number of years, it may be a little plus or minus 1% only, but it can't be 1% per annum. First, it was given as only 1%. Then it was amended. See the bracket. It was amended to 1% per annum. This is where I'm really surprised. So 10-year, upon a 20-year loan, 20% guarantee commission. What is this? So which I'm highly doubtful. So fortunately or unfortunately, the law has been amended. It says now 1% per annum. So therefore, or the actual consideration, whichever is higher. Now, so in our case, typically it comes to 10 crore. Therefore, now, but look at the proviso, it's a saving grace. For all domestic transaction, leave aside cross-border transaction and to some extent import transactions also, this proviso will come to your rescue. Guarantee taxable illaya under there, it's a question mark, I told you. But assuming it is taxable, all this valuation rule will apply. Still, this proviso will come to your rescue. Look at it very carefully, where the recipient is entitled to full ITC. Who is the recipient? But going by what is being said or implied by the department is the subsidiary company in this case, where the subsidiary company in this case is entitled to full ITC of whatever GST paid by the holding company. In our case, 10 crore multiplied by 18%, it would pay 1.8 crore GST. If the subsidiary company is entitled to full ITC of that, then in that case, the value stated in the invoice shall be deemed to be the open market value. Whatever is the invoice value you have stated in the invoice is equal to open market value. This is very important. As long as it's full ITC is eligible, which makes it a revenue neutral transaction. One person is paying the GST, other person is taking full credit. It's a revenue neutral transaction from government's perspective. So they don't care whether you pay 10 crore GST or 1 crore GST. They don't care. Other person is taking credit. In that case, whatever is the invoice value, that shall be deemed to be the open market value. You have put 1 crore in the invoice, no problem. 1 crore. You have actually charged 2 crores, no problem. 2 crore. That shall be deemed to be the open market value. That shall be deemed to be the value itself. Apana innur kelvi. Next question. If I have charged 0, sir, na invoice la potadan sir prachana. I have not put any invoice at all, sir. Then we have another circular coming to our rescue. If I am right, circular 210, my memory serves right, or circular 199, right, with these two circulars. This is for domestic, this is for import. These two circulars say, if invoice I put, sir, what should I do, sir? If you have not put the invoice and the recipient is entitled to full ITC, if you have not put the invoice value shall be deemed to be 0, and therefore the open market value is also 0. So these two circulars come to our rescue. So when we read the sub rule 2 proviso, we have to read these, keep these circulars in mind also. 210 is for import of service, which is reverse charge, whereas 199 is for domestic transaction. These two circulars say if the recipient is entitled to full ITC, invoice, if it is not raised, invoice I have not raised it. Then in that case, no problem. Invoice value is deemed to be 0. Therefore, the open market value is also 0. Provided the recipient, a very big important thing, recipient is entitled to full ITC. Now, if you ask me, these are two circulars clarify this very important point. But I've been telling to my colleagues and to other people who have been department people, etc. Circular for this, what is meant by recipient is entitled to full ITC itself is a 1 hour session we have to have. That itself is a point of debate. Sir, illness are simple than sir. Other person is taking credit, but there are so many issues there. So for that, a circular is required. If you ask me, anyway, I'm not going into that diverting. So therefore, this proviso is a very important proviso where you can still escape tax on corporate guarantee under GST if this recipient is entitled to full ITC, and application of these two circulars, you can defend the matters. But I am seeing people from power sector, etc. here, etc. Many people are there. Input tax credit there, this circular, this proviso will not save them. So certain industries, it's a very big problem. I am seeing people from NBFC, Veritas, etc. People are here. Sir, only 50% ITC, whether it will come under full input tax credit or not. It's a question mark. This is why I said, if you ask me that 50%, I'm still saying it is 100%. Then you are reversing 50% still apply. But it's an interpretation matter. So for people from banking sector, NBFCs who are going by rule 38, whether that 50% reversal will tantamount to not full ITC. That's what I'm trying to say. But at least for power sector, very clear, there's no input tax rate at all. Therefore, the proviso will not save them. Anyway, so this is the rule 28.2. Again, I'm not going, for want of time, I'm not going too much in depth into it. I'm just giving the overall things. A few things I'll reiterate. One, the value, this is a valuation rule for related party guarantees. So the value has been given at A or B, whichever is higher, and the A is 1% per annum. Amendment is there, so please take care. 1% per annum. So this is first thing. Second thing, it will apply only where the recipient related person is located in India. So in case of cross-border export guarantees, this will not apply. So we have to be very, very careful about that. And if the creditor is also a non-banking concern also, then this rule will not apply. So please keep all these things in mind. And even if this rule applies, proviso will come to your help in some cases where the recipients are getting full ITC. Fine. Now let me move on to the circular. So all these aspects I've covered now. Let me move on to the circular. Circular 204 is a basic circular. It also came into effect from October 23 only. Sir, now I have a very basic question, sir. Before I go on to the circular, now many of you will have this question lingering in your mind. I told you that this particular valuation rule came into effect from 26th October 2023. October 2023. Before that, what will happen, sir? Assuming guarantee, corporate guarantee is taxable. Assuming it is taxable, that's a very question. I've told you 4 or 5 grounds where you can still defend. But assuming it is taxable, before October 2023, what will apply, sir? The rule 28.2 was introduced only now. Before that, what is the scenario? Does it mean that it is not taxable at all? So there, if you see again, the circular 204 has clarified. Before that, you go by rule 28.1, which still covers all related party. It's a general rule covering all related party transactions. So you have to go by that. But before that, see, even now, even before, whether guarantee is taxable or not, itself is a question. But assuming it is taxable, the valuation is governed by 28.1 before October 23. Valuation is governed by 28.2 after October 23. So before October 23, after October 23, 28.1, 28.2 will have to apply. Before October 23, your grounds of defense are very strong. Whereas after October 23 also, I'm not saying it is impossible, as that movie, what is that Don Hindi movie says, what is that, mushkil nahi mumkin hai. So it is not impossible, but it is difficult to defend, but still there is ground for it. We will defend, don't worry. So there are grounds for defense even after October 23. So now coming to circular 204, it also came in October 23. Again, it gives basic clarification, so I'm not going too much into it. The circular is what is being challenged. Many of us have a confusion. Two circulars are there. In the circular, then challenge, and it has been probably the in that matter stay has been given. There's another circular that is still valid only. It has not been challenged so far. If you ask me, that should be challenged first. So this 204 circular is what has been challenged in Sterlite and Acme. So it gives basic clarifications, personal guarantee, corporate guarantee, it makes a distinction. And it says personal guarantees are not liable. So at least it says that personal guarantee, they will start asking the GST. So it clarifies personal guarantees are not liable because of the RBI circular. And therefore corporate guarantees are liable because it is not covered by the RBI circular. So this basic summary of the circular I've given. But if you ask me, corporate guarantee also, because of all those things, still can be challenged. So this is the Sharams of 204. Next, coming to 225. 225 is very interesting. So many issues clarified. Some are good, some are bad. Pass mark 4 out of 10. 4 out of 10 India pass mark. So okay, probably we can give. See, I'll be very open. See, this matter I'm being very critical. Don't think I'm having some sort of a political commentary here. No, there are many cases where I've given good feedback. Section beautiful. I used to say section 59. Moon line na. Super, very, very, very good. 59, 3 lines, but so much profound lines are there. Like that, 60, 61. I used to give praise, read with 107. So wherever praise is due, I'll give. But wherever it's not, it's bad, I have to tell that also. I think I am in that position to, after having invested probably my entire career in this, I think I have the right to say that. So therefore, 225, probably a little bit less than pass mark if you ask me. Many clarifications are valid, many clarifications are ultra wires. The rule ultra wires. We'll come to that next. But it is ultra wires the rule. 28 sub rule 2 we have seen. There's also ultra wires the act. It is unconscious if you ask me. So probably I'll take you through some important clarifications, then probably I'll open up for questions quickly. So that's what first one, whether it will apply this rule 28 will it apply to prior to 26th October. So here it has said no in that case. Rule 28.1 as existed during that time, which means rule 28.1 will apply. So not rule 28.2, if it is before guarantee given before. what is that, 26th October. Now you will have a next question, sir, what is meant by guarantee given before October 23, sir? In your case itself, you take, I said 2018, the loan is given, guarantee contract is signed, but it is spread over 10 years. Then in that case, or incidental point, if you take, this is clarified by Circular 225 also, what is the time of supply? When you have to pay GST? Should you pay every year on 1 crore, 1 crore, 1 crore, 18% like that? Or should you pay on the entire 10 crores? You were saying correctly, 10 crores is the value. Should you pay it in year one itself? What is the time of supply? Value of supply, what is the time of supply? So at least if you go by the circular, for want of time, quickly I'm moving on. If you look at the circular, it says 10%, 1% per annum, okay. It says 1% per annum, but time of 10% calculate panigonga, but you pay it in year one itself. Otherwise, government will lose interest, no? Interest and also interest. So pay it in year one itself. Look at how unfairly the provision is drafted. 1% per annum, every year you should allow me to pay at 1%. And the timing benefit, time of supply, it's unfortunately, circular says it is at year one itself. Big question mark again. All these are ultra vires the act if you ask me. Time of supply, continuous supply, if you look at it. If you ask me, it's again questionable. Anyway, so before time of supply is year one, therefore before guarantee contract entered into before 2023 October, old rule, entered into after October 23 new rule. So like that we can interpret. Next one, guarantee contract is provided for a particular amount. Let's say a beautiful example. This is where I'm saying certain case I don't think circular is in sync with that. Let's say in our case, I gave you an example, no, 100 crore loan. Guarantee contract is given for 100 crore, but the actual loan disbursed is only 80 crore due to whatever reason. I have availed only 80 crore. Now you tell me, as a businessman, you tell me what should be the, leave the law aside. As a business person, you tell me what should be the value of the guarantee in that particular case in GST law. Generally, you tell me 80 crore only sanctioned and I have availed, utilized. What should be the thing? Should the 1% per annum, in our case 10%, be calculated on 80 crore or 100 crore? Common sense you tell me. Leave, I used to say sometimes logical, rent logic is only LAWGAC, normal logic, LOGAC. The lawmakers sometimes see this logic only. They don't see this logic at all. Logica, you tell me, all of you have told me. Let me look at the chat. 80 crore without exception. But the circular, you look at it, what clarify, no, 100 crore. The loan is different. The guarantee is different. You are given for boss. The guarantee cannot be enforced. It is coexistent with the co-terminus with the loan. Correct? It can't be seen separately. The loan itself is sanctioned for 80 crores. Where is the question of paying GST on 100 crore? But the law unfortunately says 100 crore should be the value. Loan separately. One is blood, the other is tomato chutney. Anyway, that's a different thing. So there's another clarification we asked me is ultra vires the provision, ultra vires the section itself, ultra vires the constitution also. Anyway, that's another thing. Now, some important clarifications are there. Whether discharge of tax liability on corporate guarantee is to be done at one time or on a yearly basis. So this is what I clarified. It's one time only. First itself you have to pay. First you pay, then you do whatever you want. 10%, that 10 crore should be paid at initial. On that GST should be paid year one itself. That's what the circular says. Will it apply to export of service? As I told you already during 28.2, the recipient should be in India, whereas in export of service, recipient outside India. So rule 28.2 will not apply. See, if I say rule 28.2 will not apply, doesn't mean corporate guarantee is not taxable. It is still taxable on question mark. Assuming it is taxable, valuation will be under rule 28.1. 28.2 not applicable. It will still be counted by 28.1. If you ask me open market value, you have to find out. See, this poses another problem. You imagine from India, you are giving to your Singapore subsidiary one guarantee. Correct. Valuation rule not apply. I'm thankful. Lena value will be in our case 10 crore. Correct. Now, if this rule is not applicable to export of service, therefore we have to go by rule 28.1. So we go by open market value. Open market value, as many of you have said, it can't exceed 1%. So 0.5% share 0.5%. So in our case, it will be only 50 lakhs. Right? If it is an that is from India to Singapore, you are giving the guarantee. Please note, you'll have to pay 18% GST on this, which is 9 lakhs. Correct. You'll have to pay GST on this. But for export of service, the idea is that it should be a zero rated, correct? Will this be zero rated? That's the question. This 50 lakhs, boss, is a notional consideration. It will not be actually received. Therefore, it can't zero rating refund. You can't claim. So the idea is in export, export should not suffer tax. That's the entire idea. But in this case, unfortunately, circular says rule 28.2 not applicable, but unfortunately, it is still governed by 28.1. In which case, whatever this one is there, it will not qualify as export of service. It will be coming under the residual clause where you have to pay GST, but export benefits you won't be able to get. So this, I think, is another interesting case of our clients is also there. This is what I say, ultra wires. Now a loan is being it is being refinanced. When we say refinanced, loan is being taken over by somebody else. From ABC Bank, so let's say PQR Bank is taking over the loan due to whatever reason, lower interest rate, whatever it is, better terms. From ABC, PQR is taking over. Let's say in our case, 10 years loan. After the third or fourth year, the next company is taking over. PQR is taking over. Now you tell me, from a business perspective, you tell me. Contract Act also, the Contract Act against whatever is given in the circular. You tell me it is just a refinance of loan, correct? Mere assignment of loan. Or in contract law terms, we got it as novation or stepping into the shoes of the other. Right? So one bank is stepping into the shoes of the other. Will this be a new supply? Already you have paid 10 crores, boss. On that GST you have paid, boss. But in case probably service tax, right, was not paid. But actual cases, you assume post GST supplies. In our case, 2018 case. Already I have paid 10 crore in 2018. Just because the loan is being refinanced in 2025, again the circular says you'll have to now revalue the loan again and find the value again and pay GST on this again. Already it has been taxed, boss. It says if no fresh CG is issued, then you need not pay. But if a fresh CG is issued, ultimately fresh CG will be issued because the loan number will change, the creditor name will change. Just for formality purpose, the fresh guarantee will be there. But it is mere formality. Ultimately, it is nothing but assignment. Assignment is not a supply. But circular says you'll have to pay GST again. So these, on account of these reasons, I still maintain I've covered the important plan. Because of this, so many challenges are there. Sterlite Power, Acme, which I've told you. So this is Punjab, Haryana, whereas this is, I guess, Delhi. Some other case also is coming up, but predominant case I've told where beautifully it has been analyzed. Others are mere 1 line or 2 line stray orders are there. These are nice analyzed cases. At least some extent they have gone into the provisions. So therefore, the questions come whether the circulars are ultra wires. Whether rule 28.2 itself is ultra wires. I'm not gone into the wires. Why it is ultra wires? Rule 28.2 itself is ultra wires. The act itself, I'm not gone into that. Bad drafting, I told you, but I did not tell you why it is bad drafting. If I go into that, another half an hour will go in that. But a lot of reasons, rule 28.2 is badly drafted. It is ultra wires if you ask me. See, I'll just give you one example why I say it's ultra wires. We saw that in our example, XH and XS, they are not the contracting parties, right? So XS is not the recipient. Who is the recipient? The bank is the recipient, we saw, right? But if you look at rule 28.2, it proceeds on the assumption that the subsidiary company is a recipient of supply. Wrong. It is ultra wise if you look at 293. It is ultra wise section 2, subsection 93, which defines what is recipient of supply. That there is no consideration. Who is the recipient of supply is still defined. So you cannot assume that the subsidiary is the recipient of supply. Bank is a recipient of supply, even under rule 29 subrule, section 2 subrule, subsection 93. Bank is a recipient, it's not the subsidiary company. So because of this, rule 28.2 can also be challenged. It is ultra wise if you ask me the provisions of the basic act itself. Rule cannot override the act. So on account of all these reasons, to summarize, this corporate guarantee has remained a hot topic and it will continue to remain. A government is not letting it go. I already won some cases here. I see a lot of litigation that is coming, especially from DJ and other central jurisdiction. I'm seeing a lot of states will definitely catch up. I've seen in some other cases, states also, they are already catching up to this. So it has been a subject matter of litigation. Next, after 10 years, we meet also. Probably my hair would have grade, but the concepts what we have discussed today will hold good 10 years also. So hopefully there is some sort of sanity which prevails and very reasonable. See, okay, you want to collect tax on this. Government has made its intention very clear. But what I'm saying is there are a lot of reforms which are required. Then one, for example, that 1% rule itself has to be redrafted. Please take our views. We'll draft the rule. Probably in half an hour, we'll draft the rule properly and give. So please take our views and draft the rule. It requires a lot of redrafting. So draft it properly. 1% per annum, if you ask me, is atrocious. So that can't be the case. So you'll have to reasonably ensure that the provisions are very reasonable. Again, I remember the word of Chanakya, again, words of Chanakya, which says you government should collect tax like a, what is it, honeybee from honey. I mean, from the flowers, right? The pain should not be felt. But here in corporate guarantee, the pain is being felt by the industry. See, first of all, there's no consideration. Pay tax on it. You have to make it reasonable. So with this small end note, I'll probably open up to any questions which are there from I thank you for all for patiently listening. I know I've exceeded the time a little bit, but I hope I kept you engaged. So therefore, now open to any questions quickly. Anyway, I'll also share my number to you. So this one, you can always get in touch, but any quick questions, we'll take it up. Any questions? So probably, yeah, I'll share the entire presentation also. It will be sent to whoever has registered. You can go through. Detailed, this one will be there. But for now, is there any question?
Question in the chat box. It's by Venkat Manju. Subsidiary companies and business. Can you see that?
Yeah, exactly. So Venkat, this is exactly the thing where I was saying, we are talking about the rule 28.2 proviso, whether the recipient is entitled to full ITC or not. What situation you are pointing out is rule 42 situation. So where exempt and taxable supplies the recipient is doing, it has to reverse a certain part of the common credit under rule 42. It's a big question mark. Whether that can be considered as not entitled to full ITC is a big question mark. If you ask me, it may not violate that full ITC concept. Please note, in rule 42, 43, or in case of banks also rule 38, I told you, you are first availing the credit, then you are reversing it on a calculation basis, summary basis. That particular transaction-wise analysis reversal, you are not doing. At least under rule 42, if you look at it, for certain transaction directly relating to exempt supplies, you are not entitled to take. So probably that may get hit, or some 17.5 blocked cases, that may get hit. But on a summary level turnover basis, you are doing the reversal, or 50% on a summary level basis. If you ask me, strictly speaking, will not come under full ITC, not eligible cases. So, but as I told you, adukku or circular தேவை. நீங்க கேட்ட கேள்வி நல்ல கேள்வி, பதில் இல்ல. I've given my views, but if you ask me, a circular is required for that aspect specifically.
There's
Any
one
other?
that by Akshay Kumar. The company has taken a bar.
Bank OD and director provides collateral. So director provides a collateral. Okay, so fine. He is not giving a direct, what is that, a guarantee. Rather, collateral is being given by the director of the company. Happens in certain cases. It's a question mark. See, again, actually, instead of answering your question straight away, what I'll say is I'll give a question for a question, where whether it will fall under the ambit of supply. The director is giving his house or land or some FDs or something like that as a collateral, right? Does it fall under the ambit of supply under section 7 or read with schedule 1 or schedule 2? If you ask me, it's a question mark only. If you ask me, it may not, strictly speaking, but a wider interpretation is taken, probably yes. So probably in my view, strictly speaking, may not. There's no supply in that particular case. Rate of GST on corporate guarantee, a residual clause, sir, 18%. So our value we have discussed in our cases, 1% per annum, that's the value. So in our case, 10 crores we saw. On that, 18% is the GST rate. So if it is taxable. So CS is asking on enhanced facility. Hopefully it will be chargeable on the enhanced amount only. I think to this query, at least I have to share the screen. Okay, fine. Let me look at the circular 225. Probably you look at circular 225. I think the situation is covered, wherein on any enhancement, etc. done, it should be on the enhanced amount only. But I don't think it's directly covered by 225. Let me check. But yes, ideally speaking, yes, it should be only. That is where I'm afraid. If you are, see, again, the circular may go and say, if you are cancelling this, let's say 700, that in our case, 100 crore guarantee is being cancelled, and then you are giving a fresh guarantee for 105 crores, then there is a debate. As per the circular, if you see, on the full 105 crores, again, you have to pay the GST. Whereas, no, collateral or an addendum or a codicil, we used to say, for extra 5 crores, you're adding it, then probably not. Question. Circular 225 doesn't answer this, but how we are going to give that extra guarantee is the question mark. Contract structuring, that's why it has a lot. That's why you should probably ask your advisor before doing any of these activities. Contract structuring may play a role in this. Raghuramji saying we are an SEC, we give guarantee to overseas. Like generally SEC considered as a foreign territory both under SEC Act as well as GST law. But strictly speaking, if you ask me, here the problem with export of service is that the consideration is not received. So if it is consideration not received, it's a notional consideration that we are saying, correct? If are you receiving actual consideration or not? Raghuramji, you have to probably give that feedback also. Are you receiving actual consideration? Yes. Then probably yes. If you receive it in foreign currency, right, or wherever permitted in Indian currency by RBI. So if you're actually receiving the consideration, then okay, fine. Probably you may take a case that it is taxable, but ultimately zero rated, because place of supply also falls under residual clause only. So it may tantamount to export. I have to see the facts more clearly, but it may tantamount to export under section 2, subsection 6 of IGST, assuming other conditions are satisfied. Any other question? So,
what time do you need to leave MSP? You'll have to tell.
Yeah, I know, that's what I kept it. Not an issue. It's management. So since I'm okay. Any quick questions, we'll take it up. Otherwise, I think people will also get impatient after like it's been 1 hour 15 minutes.
True.
Yeah. So anyway, thank you all for patiently listening. So reach out to us for any at Shreyas for any further questions you may have. And again, thank you all for interacting. Also, and Nikki, over to you.
Thank you so much, MSP, for fantastic. I mean, I was glued to the session, even though, as you said, I'm a non-GST person, but still, as a business owner and as you know, it's still very, very essential to know these facts about the law as it stands. Thank you so much for the nuances. And we thank you all of you who attended and stayed on to the end and asked so many questions. We look forward to meeting you again next week. Please stay tuned in with us. Every Friday evening, we will come up with a topic which will be useful for you. Thank you. Bye-bye. See you all. Good evening to you all. Bye-bye. We're closing.